politics is often about symbols. And there's no symbol more powerful than the rich. In 1990, the United States government was facing a big budget problem. So President George H.W. Bush and the Democratic Congress came up with a plan that sounded perfect. They decided to tax the toys of the super rich. They passed a law with a specific new rule, a 10% luxury tax on items that only wealthy people buy. Things like private planes over $250,000, furs and jewelry over $10,000, and most importantly, yachts costing over $100,000. The logic was simple. If you can afford $1 million yacht, you can afford an extra $100,000 in tax. It was the ultimate Robin Hood tax, taking from the rich to help balance the budget. Who could possibly object to taxing a billionaire's boat? Well, within just 2 years, the tax was repealed in a panic. It didn't raise the money everyone expected. In fact, some economists argue it actually cost the government money. And instead of punishing the rich, it punished a group of people the government never intended to hurt, blue-collar workers. These are things you need and will buy no matter the price, like insulin, water, or electricity. Then there are things with elastic demand. These are things you want, but can easily live without or buy somewhere else, like yachts and furs. The demand for new yachts is extremely elastic. So when the price suddenly jumped by 10% because of this new tax, the rich buyer had a lot of options. First, they could just not buy a new boat. Second, they could buy a boat in another country, like the Bahamas, and register it offshore. Third, they could buy a used boat, because the tax only applied to new ones. And that's exactly what happened. When the tax hit in 1991, the rich simply stopped buying new American-made boats. They didn't suffer. They just changed their vacation plans. They felt zero pain. Now, let's look at the supply side. Who actually builds these yachts? It's not billionaires in tuxedos. It's carpenters, electricians, fiberglass workers, and engine mechanics. These are skilled, middle-class jobs, often in coastal communities in states like New Jersey, Florida, and Maine. The supply of labor for boat building is inelastic, at least in the short term. These workers need their jobs. They can't just pack up and move to the Bahamas to find a new one. So when the demand for new yachts completely vanished, the rich didn't suffer, the workers got fired. The numbers are just staggering. Before the tax, the U.S. marine industry was booming. But in 1991, the very first year of the tax, sales of large boats in the United States dropped by over 70%. One famous builder, Viking Yachts in New Jersey, saw its workforce plummet from 1,500 employees down to just 68. They didn't just lay off a few people. They almost ceased to exist. Across the entire industry, it's estimated that somewhere between 25 and 30,000 direct manufacturing jobs were lost. And if you count the indirect jobs, the suppliers, the marinas, the small businesses that supported the industry, that number is probably closer to 75,000. Now here's the real kicker. The government had projected that this luxury tax would raise about $31 million in its first year. It only raised $16 million. But think about it. The government then had to pay unemployment benefits to all those thousands of workers who lost their jobs. And all those workers stopped paying income tax because they no longer had an income. Economists who studied this concluded that the loss in income tax revenue, combined with the cost of unemployment benefits, was far greater than the $16 million the tax brought in. The net result for the government was negative. They spent more money dealing with the fallout of firing the workers than they ever collected from the tax on yachts. So why was the demand so incredibly elastic? A big part of the answer is globalization. A yacht is a mobile asset. If you buy a house in New York, you have to pay New York property taxes. You can't just move your house to Florida to avoid them, but a yacht, by its very nature, moves. Wealthy Americans quickly realized they could go buy a brand new yacht in Italy or the Cayman Islands. They'd register the boat in a tax haven, flying what's called a flag of convenience. They could then sail that boat right back into U.S. waters for up to 6 months a year without having to pay the import duty or the luxury tax. So the tax didn't really function as a tax on luxury. It functioned as a tariff on American manufacturing. It made U.S.-built boats 10% more expensive than foreign-built boats. It was basically a subsidy for Italian and French boat builders, paid for by the jobs of American workers. This whole episode reveals the danger of symbolic legislation. The politicians passed this law because it looked good. It was an easy political win to say you were soaking the rich, but the story doesn't end there. Senator Ted Kennedy and Senate Majority Leader George Mitchell, both Democrats who had supported the tax, eventually led the charge to repeal it in 1993. Why the change of heart? Because their constituents, the boat-building workers in Massachusetts and Maine, were screaming at them. The political optics had completely flipped. In 1990, the dominant image was a rich guy sipping champagne on a yacht. By 1992, the image was an unemployed carpenter standing in front of a closed factory. When the hard reality of economics collided with the easy optics of politics, reality eventually won. But it took 3 years and tens of thousands of destroyed livelihoods to get there. This lesson is incredibly relevant today. We constantly hear proposals for wealth taxes or special taxes on luxury goods as a way to fight inequality. And the intention behind these proposals is often noble. But the yacht tax teaches us that capital is mobile. If you tax something that can move, like money, stocks, or boats, it will move. If you tax something that can't move, like land or real estate, the tax usually sticks. France learned this lesson in 2012 when it introduced a 75% super tax on its highest earners. What happened? Wealthy people simply moved to Belgium and London. France ended up losing tax revenue and eventually scrapped the tax. The lesson here isn't don't tax the rich. The lesson is be smart about how you tax the rich. Don't tax them on things they can easily stop buying or move offshore. The luxury tax paradox is a perfect example of what economists call tax incidence. Tax incidence asks the most important question. Who actually pays the tax? It's not always the person who writes the check to the government. The law said the rich would pay, but the market decided the workers would pay. The rich paid with their patience. They just waited to buy a boat or bought one somewhere else. The workers paid with their jobs. So, the next time you hear a politician promise to make someone else pay for your free lunch, remember the yacht tax. Check the elasticity. Because if the person who's supposed to pay the bill has a private jet, they might just leave the restaurant before the check even arrives. Thanks for watching. If you found this interesting, please hit that like button and subscribe for more deep dives into the hidden world of economics. See you next time.